everyone, welcome to the Passive Investing Show. I'm Ashley Wilson and I'm joined here with my co-host Jay Scott. Hey Jay, how are you doing?
I am doing awesome. I'm really excited to be here on the first episode of the Passive Investing Show. How are you doing today, Ash?
I'm doing great as well. For those listeners who don't know who you are, they're either living under a rock or I don't know what's going on, but can you tell a little bit about yourself, your background, and how you came to co-host the Passive Investing Show with me?
Yeah, so I am a business guy by education. I spent about 20 years in the corporate world doing boring corporate stuff until I finally took the plunge back in 2008, quit my corporate job, and started investing. And for the past 15 years, I've invested across asset classes. I'm probably best known for some of the work I've done in residential real estate. I've written a few books and hosted a podcast or two and talked a lot about residential real estate investing. But in addition to that, I also do a whole lot of investing in other asset classes that I'm really excited to be talking about on this show. And I look forward to talking about not just my active investments, what I spend my time doing day to day, but also the passive investments and how I'm building wealth towards retirement. So that's kind of how I got here. You and I are business partners. So for anybody out there listening that doesn't know that, Ashley and I are partners in Bar Down Investments. We buy, reposition, and resell large multifamily apartment complexes. And so that's how we ended up here together. Why don't you tell our listeners a little bit about you and how you got here?
Like you, I came from corporate. I actually was in pharmaceutical clinical research and development for three of the top pharmaceutical companies in the world. And while I worked in corporate, I started to have my money work for me passively. And I did so in several different investment vehicles, most notably real estate. And that's, I think, what I'm most known for today is my single family and multifamily business that you and I share. But I also invest passively in a lot of different investments, a lot of different asset classes. And that's just another thing that you and I have in common. I think it's really important, Jay, if we transition now to talk about why we are doing this show.
Yeah, so you and I have been talking about doing this show for a long time now, but the biggest reasons are that the investing landscape has changed considerably over the last decade and a half since the Great Recession. A lot of people have accumulated a lot of wealth. There's a lot of money out there. In addition to just hard assets doing really well over the past decade and going up in value, and a lot of people accumulating wealth. As we all know, during the last couple years during COVID, a lot of money was printed. A lot of money has kind of flowed out into the hard asset sectors, things like the stock market and real estate and crypto and other asset classes. So there's a lot of money out there. But in addition to that, back in 2012, President Obama passed the Jobs Act, which basically changed the investing landscape. It gave ordinary investors like you and me, those who have surpassed kind of a minimum bar for net worth or income, has given those investors like us the ability to invest in a lot of alternative asset classes. It used to be that we could take our money, we could put it in our IRA, we could put it in bonds, we could put it in stocks, we could buy real estate, but there were a lot of alternative investments. Things like investing in businesses, investing in things like artwork, investing in funds or real estate syndications, things that really weren't available to the average investor. These things became available back in 2012 with the passage of the Jobs Act. And so over the past 10 years, what we've seen is a lot more alternative investments have now become available because now more investors are able to invest in those. And now we're starting to see a lot of investors start to flow into these sectors. But what I'm seeing is that a lot of investors aren't very knowledgeable about these alternative investments. They don't know how to underwrite them. They don't know how to do due diligence. They don't know the right questions to be asking. You and I have invested in a lot of these types of investments. And I know even you and I today are constantly talking about all these different potential passive investing asset classes that we would like to get into, but we know absolutely nothing about. So I think one of the catalysts for us starting this show, not just to help our listeners learn about all these different asset classes that are out there, but also you and I for us to learn about what are the different possibilities for us, and where should we be focusing our time, attention, and money for our own investments? And so I really very much look at this show as an opportunity for us to learn, as well as for us to educate our listeners. So with that said, I know you and I have been able to grow our wealth passively over the past 10, 15, 20 years. What are you thinking in terms of how we're going to position this show, and how we're going to use this show to both help ourselves and our listeners?
That's a great question, Jay. And I think based off of our shared experience of passive investing, we know how to vet deals. We know the right questions to ask in terms of how to figure out how to do the due diligence, how to vet teams, how to vet the asset class itself. So in terms of looking for key opinion leaders in that particular space, also being just exposed to those different investment opportunities, there's so much transferable knowledge between different asset classes. So by learning one asset class and then learning another investment opportunity, there are a lot of things that can carry over in terms of the questions you can ask. So bringing these excellent leaders onto our show, allowing them to divulge what investment opportunities they have, coupled with how they structure their own passive investing portfolio and how they're continuing to grow wealth, is going to be the focus of the show. So while we are going to bring on people that we have maybe personally invested in, or maybe we haven't invested in, we also too are going to be learning with the audience. So we are going to ask the questions that you will want to ask to these key opinion leaders to make sure that you have the proper knowledge and the exposure to the investment opportunity for you to make your own decision on whether or not this asset class pertains to your investing style. To that end, I think what we should talk about now, Jay, is what we're currently investing in, how we vet these investment opportunities, and why we have picked these different asset classes. So Jay, do you want to kick us up?
Yeah, absolutely. So I kind of think about my investing from kind of in two ways. One, there's the active investing I do, and these are the things that I spend my time, I trade my time for money and returns. And for the most part, 100% of my time is now spent with you, Ash, doing multifamily syndications. But then there's the other half of my investing life, and that's kind of the more personal and private part that I don't get the opportunity to talk about as much, and that's the passive investing I do. That's the thing that I trade my, not necessarily my time, but I trade my expertise, I trade my money in return for returns. So the things I put my money into to get a passive return without having to spend a lot of time. And these are the things that I'm using to grow my wealth, hopefully be able to pass on some of that wealth and hopefully cash flow to my family and kids at some point. And so when I think about active investing, again, the thing I'm trading my time for, I'm very focused. I want to get really good at one thing because I'm using my time and knowledge and expertise to build my net worth. But on the passive side, because I'm often relying on other people to invest my money, or I'm relying on vehicles that I don't have a lot of control over, I'm not as singularly focused. Instead, I want more diversification. I want to make sure that if one of my investments does poorly for some reason, either somebody doesn't manage it well, or I get unlucky, or the economy tanks, that my other investments can kind of offset those losses. I don't need to be actively managing them. So when I think about my passive investments, I typically have two buckets. One is the money that I give to other people that I trust other people to invest for me. And for me, that's about 30%. About 30% of my passive investing budget goes towards other people. And two major asset classes that I invest in there. One is syndications. So I invest a bunch of money in other real estate operators who are doing everything from multifamily to self-storage to notes and other types of real estate syndicated investments. Number two, I invest what are called angel investments, and we'll talk all about that on future episodes of the show. But it's basically I'm investing in startup businesses, and that's where I take my money. I invest in business owners who hopefully are growing those businesses and then giving me a good return when they either sell the company or they go public or whatever it is. So about 30% of my portfolio is specifically going to other people for the deals that they're operating in hopes that they operate those well and they provide me a good return. The other other 70% of that money is going either to my own deals or our deals, or going to passive investments that aren't necessarily controlled by other people. So for example, a good bit of that money is going to our syndications. You and I basically buy large apartment complexes, and we give passive investors the opportunity to invest with us. Well, we also invest with ourselves. We put our money into our own deals. So a lot of my passive investments are in our own deals. In addition, I invest in single family residential. I own a bunch of passive rentals. By passive, I don't mean that I do nothing on them, but for the most part, I do very little. I do a bunch of work up front to figure out what to buy, and then buy those properties and put them into service, hire property management to take them over, and then hopefully I'm spending less than an hour or two a month focused on those properties. So that's another piece of my passive investment portfolio. And then I invest in a whole bunch of other asset classes, things that a lot of people probably don't think about. Crypto is one. I know that's becoming popular these days. I've been investing in crypto for about 5 or 6 years now. I own a bunch of racehorses, which has been a very interesting passive investment for me. Looking forward to talking about that in the future. I've invested in things like filmmakers and films. I've been an executive producer on a couple private films, and we can talk about that at some point. But basically, my passive portfolio is well diversified. So again, if one piece of the portfolio doesn't do well, hopefully other pieces are doing well. That's kind of my general thoughts and my general thesis on passive investing for me. And hopefully we'll have a chance to talk about that in a whole lot more detail in future episodes. With that said, I'd love to hear more about your passive investing and what you invest in, Ash.
We are so similar, so I don't want to reiterate similar concepts, but in terms of how I look at investing and that emphasizing the how part of it, every investment opportunity for me, and also how we advise our passive investors at Bar Down Investments, breaks down to 3 components. Those 3 components are the team, the asset itself, and the market. And when you break it down to that level, it becomes very clear as to what questions you should ask and how you should vet each investment opportunity. It also becomes very clear on how you should structure your passive investment portfolio. In other words, we are very detail oriented in looking at those different factors to make sure that we have safeguards in place for exactly what you just mentioned, Jay, where you are not putting all your eggs in one basket. If you're in one specific asset class, for example, you and I are both, let's say, in multifamily, which obviously everyone knows, we aren't passively investing just with one operator within one market, within one type of multifamily asset. We diversify across all 3. We might be invested in a new construction, a 1970s property, a markets, for example, like Atlanta, to another market, for example, like Houston. And then we also too are with different operators. The reason being is so many different things can happen across the specific asset, across the market, and across the team, that you don't want that exposure solely on a huge part of your investment portfolio. So that is really how I break it down personally. I don't only give that advice to investors, I actually take that advice and make sure that we are well diversified. Specifically, and I know you mentioned some of the asset classes that you're involved in. Just like you, I am invested in horses, but in a different capacity. I personally am invested in training horses and then turning around and selling them for a profit by first importing them from Europe, bringing them to the US, training them, and then selling them a short time later. So that's one unique venture that I am involved in. I am also invested in blockchain and crypto. We are also, my husband and I are also invested in insurance, in mortgage notes, a lot of different asset classes that aren't traditional real estate investments, which I know you and I are both known for. Another example is precious metals. So we are looking to be as diversified as possible, because at the end of the day, while we do have our active income, and that's the multifamily sector, which a lot of people know us for, we also too want to make sure our money is working hard for us. And that's a theme that we will continue to stress throughout every single episode of this show. You want your money working as hard for you as you are working hard for it.
Yeah, I 100% agree. And I think the key takeaways for both of us here are we love diversification. We love to make sure that we're doing strong due diligence and underwriting on these deals, because ultimately a passive investment isn't passive from day one. Normally it takes upfront work to pick the right investment and pick the right operator and pick the right location, the three things that you mentioned. And so you have to be able to do that due diligence upfront to make sure that you're investing in the right things, because ultimately once you make that investment, once you turn over that money, now it's pretty much out of your control. And I think, as we both kind of alluded to, the goal and one of the main goals for this show is to help not only us but our listeners learn what are the right questions to be asking so that we can do that due diligence, so that we can make smart investments. Now, we're going to be talking to a lot of different people on this show. And the hopes are that we can get a lot of different opinions about it, a lot of different asset classes, and not everybody's going to invest the same or think the same way. But what we do want to kind of do the same for every episode is, after talking to these experts, after talking to these investors, after talking to these operators, we do want to end each show with the same three questions for each person to kind of give us some insight into how they're thinking about their investments today and the market today. And I think we wouldn't be doing the show justice if we didn't jump into those same three questions that we're going to be asking each investor for ourselves. So if it's okay with you, Ash, I would love to ask you those three questions. I guess you can ask me those three questions and maybe give our listeners a little bit more insight into what we're thinking about today and how we're looking at the market today and how we're looking at the overall investing landscape.
Yeah, fire away. Let's go.
Okay. So the first question I think we're going to be asking our guests is some form of, what new thing have you recently started researching or investigating that you're considering investing in the near future?
Well, Jay, you know that I'm an environmentalist at heart, so it probably does not come to a surprise to you, but I am very interested in carbon credit investing. So there is a huge new landscape of buying and selling of carbon credits, and this is all due to our future. It's due to the environmental landscape that you and I and our children will be living in. So it's a new asset, relatively new asset class that a lot of people are spotlighting. There's a lot of attention on this asset class. So I am very interested in researching this further and seeing how we can get in on the game.
Yeah, love that. Personally, for me, I'm looking at a whole bunch of different things. I think I'm always looking at a whole bunch of different things. And with the launch of this show, we're getting the opportunity to talk to a lot of really smart people who are introducing us to a lot of new asset classes that we should be considering. So I'm looking at oil and gas. I'm looking at insurance. I'm looking at investing in other countries. So business ventures in other countries. But I'd say for me, one of the big focuses for me over the last couple of years has been crypto. A lot of people think of crypto as cryptocurrency or the tokens. A lot of people have been buying tokens. But for me, it's the underlying technology that I'm very interested in, a technology called blockchain. And for me, I'm less interested in buying these blockchain tokens, the cryptocurrencies, things like Bitcoin and Ethereum and all those other coins you may have heard of. And I'm actually more interested in the companies that are developing the blockchain technology. Some of these companies are developing cryptocurrency or crypto tokens. Others are developing foundational technology that's really going to revolutionize the way we do all types of transactions, whether it's currency or anything else. And so for me, a lot of what I've been focused on for the last couple of years is these blockchain companies and investing directly into the companies as opposed to the tokens and the currencies that they're creating.
Couldn't agree with you more. Switching to our second question, what current legislation or economic situation poses the greatest threat to your investment strategy?
Yeah, so I'm probably a little bit different here. I focus for our company and what we do. I focus a lot on fundraising. So I work with a lot of other investors. I help them invest with us, but I also provide a lot of advice to investors on what to invest in, whether it's with us or whether it's with other operators and other asset classes. And so for me, what I'm often keeping my focus on is how government regulation is potentially impacting us passive investors. And what I've seen over the past, I'd say 15 years, basically since the Great Recession, is that there's a lot more government regulation these days that's impacting us. Some of it's good, but some of it is not necessarily so good. So just over the past couple of years, what we've seen is some regulation that's been proposed that could limit the amount of investment into these alternative asset classes from things like IRAs. There is a definition of who is allowed to invest in these types of alternative investments. You'll hear the term accredited investor, and we'll talk about what an accredited investor is on future shows. But the government's talking about raising the bar for becoming an accredited investor. So investors are going to have more money or more income in order to be able to invest in these alternative investments that we've been talking about. That hasn't happened, but it's been talked about for the last few years, so it certainly is a risk. So these are the types of things that I'm thinking about. What are those government regulation, pieces of government regulation that could ultimately hurt my ability to invest, whether it be my personal funds or my IRA funds, or whether it's going to impact investors into our deals or just people that I advise on a daily basis. So how about you, Ash? What are the biggest pieces of regulation that you're concerned about or that you're focused on that could impact your investing and your investing strategies?
I am specifically looking for recession resistant investments. And I think that boils down to the fact that we can all agree we're in an environment with high inflation. And the question is whether or not the cooling of that inflation is pushing us potentially further into a recession or to a recession. It depends on whether or not you believe that we're currently in a recession or we're heading to a recession, towards a recession. But those are the things that I am very concerned about. So I'm watching how inflation is growing and then whether or not it is slowing down and easing, how interest rates are being impacted, or interest rates, excuse me, are impacting inflation. There are a lot of different components. I don't think it's very easy to look at the landscape that we're in today and identify whether or not we are going to continue the uphill climb with inflation or if it's going to cool off. So just being very attentive to what the Fed is doing with our interest rate hikes and making sure that the investments that we are looking to invest in or are currently invested in aren't going to be negatively impacted by these changes and modifications that the government is doing.
Yeah, absolutely. And I think we're all thinking about where are we headed from a macroeconomic standpoint? Are we headed towards a recession? And so I think you're probably not alone in asking yourself those questions about where we're headed and what we should be doing differently. And I'm sure we'll talk about that a lot on this show. So that brings us to question number 3 that we plan to ask all of our guests on this show. And that's, what is the best piece of advice you've ever received or the best piece of advice that you have for our listeners? Ash, what is the best piece of advice you've ever received or the best piece of advice that you have for our listeners?
The best piece of advice I've ever received is the harder I work, the luckier I get. And that can be taken in so many different meanings. One is it can be taken with your active investments, but it also can be taken on your passive investments, meaning that the harder your money works for you, the luckier you get. Jay, you mentioned earlier that passive investing isn't truly passive, that you do have to do some upfront work, and that work is hard. So the harder you work upfront, the more I personally feel that you can sit back a bit and have your money start to work hard for you, otherwise known as the luckier I get. So that to me is something that I live and die by, is that motto. But for you, Jay, what about you? What is the best piece of advice you've ever received?
So I've received a lot of great advice. The thing that I think I want to touch on here, because this is a show about investing and specifically passive investing, and I often talk about investing theory. And one of the pieces of kind of investing theory that I think is often overlooked by a lot of investors I speak with, a lot of investors that I talk to, is that risks and returns are related. They're intricately entwined. And generally, the higher the returns that you can expect from an investment, the higher the risk from that investment. The lower returns that you expect from an investment, the lower the risk. Risk and returns are directly related. So for example, if you're investing in bonds, well, you may only expect to receive 1% return, a 0.5% return, 1.5% return, very, very low return, but in return you get very low risk. On the other end of the spectrum, when you invest in things like high risk business investments, so early stage tech startups is something that I've enjoyed investing in, but it's high risk. Now, the nice thing is with that risk comes potentially very, very large returns. A lot of investments kind of fall in between. They're not the 1% returns. They're not the make 100 times your money returns. They're investment returns in the 8%, 10%, 20%, 30% range. And it's important that we always remember that the returns that we can expect, or the returns that are projected, are directly related to the risk. When you hear about an investment that's potentially returning you 25%, you should be thinking this is a higher risk investment than an investment that's potentially returning you 15% or 10% or 5%. So I just want our listeners to remember, as they're listening to future episodes of this show, that high returns are fantastic. I like investments that return high percentage numbers. But at the same time, if I'm going to get a high percentage return or potentially get a high percentage return, I have to accept that that investment is probably higher risk. There's no free lunch with investing, and anytime you're promised high returns, expect that there's going to be high risks associated with that investment. Anything I missed, Ash?
No, I think you covered everything. I think it's just time to let the listeners know where they can find us.
Yeah. So if you want to check out more episodes of the Passive Investing Show, please subscribe on your favorite podcasting platform or application. And make sure you check us out on YouTube. We will be streaming every episode on YouTube. You can subscribe, you can like and subscribe at youtube.com/The Passive Investing Show. Thanks again for listening, and we hope this episode helped continue your journey having your money work hard for you.